But we begin with our expert panel and three things investors ought to be thinking about right now. On the Barron's Roundtable, my colleagues Ben Levisohn, Teresa Rivas, and Jacob Sonenshine. So Ben, decent gains for the stock market this week. The Dow hit a new high. But you say when you look under the hood, it's even better than it looks by the numbers.
No, it really was. I mean, this was the kind of week where if you look at it, you had to think, oh my gosh, the tech stocks must have done well. Magnificent Seven must have done well. They didn't. Instead, this was all about the other stocks in the S&P 500. Around 400, maybe more, of those stocks went up this week. And that was enough to propel the market higher, despite, not much news out there. It was really just to sort of buy everything that hadn't been dominating the market. We had good earnings from Deere and from Gap, and these stocks just popped. And so this was just a good thing to see, the breadth expanding and leading the market higher without tech.
So you mentioned without tech, NVIDIA reported earnings nearly doubled from a year ago, and the market yawns.
Market completely ignored it. Going into the print, the options market was projecting about an 8.6% move in either direction. It moved 0.5%. It really got no reaction from the stock market. And that's kind of what we've been seeing is that there's a bit of exhaustion in these big guys, but you're seeing the strength elsewhere. So chips actually did pretty well, even without NVIDIA doing well. And software stocks are doing even better than that. There's an ETF, IGV, which I look at, which is a software ETF. It was up over 2% this week. It did really well. And I think that's just what's happening, is people are moving away from these big tech stocks and looking elsewhere for ideas.
Snowflake, the new AI play.
That's right.
So bond yields, we're watching them very carefully. Down a little bit this week, but it still could be worrisome as we sort of kiss that 4.5 level.
Right. Well, the 10-year yield dipped just a little bit, but it's still well above 4%. We've also seen 8 weeks of higher yields for the 2-year. People are watching and they're wondering about growth and they're wondering about inflation. And we're going to get readings on both. We're going to get the second reading of third quarter GDP. It's not supposed to change, around 2.2%. And then we're going to get PCE, which is the Fed's favored metric for inflation. That's supposed to come in at 2.3%, which would be up from 2.1. But a real beat on inflation could probably stop this market in the tracks.
All righty. Thanks, Ben. Meanwhile, Teresa, we saw that it was the best of times and the worst of times for retailers. A tale of two shoppers.
That's true. So we had Walmart and Target earnings this week. Another great quarter for Walmart. And Target had its worst day in years, unfortunately. Not only was the quarter bad, but its guidance was also bad. And what's really interesting here is when Walmart reported, they said that shoppers were buying essentials like groceries, which is their bread and butter, but they were also buying from the general merchandise, which has more discretionary items, wants versus needs. Now, Target is supposed to do really well with discretionary items, but they actually said that spending was down. So you might be asking what's going on here. Is this a Target-specific problem? And well, I don't know what to tell you. I'm doing my best. This dress is from Target. You should see my red card bill. It's not good. But apparently other people aren't so much. Target has had merchandising problems in the past that could be happening here. It could just be that Walmart's e-commerce is scaling up more quickly. And also, Target has been lowering prices, but Walmart still just has that reputation for value out there. It's just vibes.
And that problem with with Target lowering prices, that it might need to lower them even further to get the customers to come in. That hurts margins, not great for the stock.
We saw that in 2022 as well. That was a big problem for Target.
Yeah, I think Target lost like 20% in that day that it reported earnings. Ouch. So Jacob, it's been a tough year for the snack food makers. First, with Ozempic and the other weight loss drugs, there was concern on investors that people would just be buying less of that stuff. And then RFK Jr. nominated to run Health and Human Services, and now there's fear of a government crackdown on Oreos and Cheetos.
And the issue is that RFK Jr. wants to see food stamps not applicable to certain unhealthy foods, but also ban dyed foods. You think of Fruit Loops, that's owned by Kellogg. So that stock is doing okay, but it's not good for the business. Hershey's, Kraft Heinz, and Pepsi have had a rough go of it, certainly since the election, by the way. Those stocks are way down since then. Goldman Sachs analysts talking about, more than 20% of revenues for Kraft Heinz and for Hershey's coming from lower income consumers, which would be, affected by RFK's wish. The thing that you have to worry, that they have to think about, in terms of like, hold your horses, maybe this isn't so bad for the stocks, is that I don't know what the Trump administration wants to do, and I don't even know that Congress is going to go ahead with RFK running HHS.
And in the worst case scenario for Fruit Loops, the Wall Street Journal showed a picture of European Fruit Loops versus American. The colors aren't quite as bright, but I think my kids will still like them. Thanks, Jacob.